Hello, chart watchers, and welcome to this Friday, June 29th Market Watchers Live show with your hosts, Tom Bowley and Aaron Swinlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the market is continuing some of the strength it saw yesterday. You can see the Dow Jones, after reversing yesterday, is up another 217 points today. The S&P 500 up 20. The NASDAQ on a relative basis, maybe lagging just a bit, up 41 points, and the Russell 2000 lagging a bit as well, but also reversing off of yesterday's lows, up 6 points today. 10-year Treasury yield relatively flat at 2.84%. Volatility continuing to drop. Talked about this yesterday, got up into that 1820 zone, which many times marks short-term bottoms during uptrending markets, and the VIX backing off and the major indices moving higher as a result. Financials leading to the upside, having a really nice day after breaking down 2 days ago, back on Wednesday. We did see a reversing piercing candle yesterday on the XLF, which normally signals at least a short-term reversal, and we are seeing that today. Bank index up almost 8 points, 450 to 455, really good support. We went right down into that area on Wednesday, bounced yesterday, and continuing the rise today. Nike had blowout earnings yesterday. Also, I think traders excited about a rebound in their North American sales. Nike up more than $8 to $80 today. Huge breakout there. Vertex Pharmaceuticals making a huge run. I'll be talking a little bit more about July seasonality, but Vertex was one of the stocks I mentioned about that having solid June bullishness. If you look back historically, was doing pretty well in June until the last week or so, but is rebounding strongly today, more than 10%. Wells Fargo, one of the stocks leading the bank index, and you can see Wells Fargo actually breaking to a 2-month high here. When you look at the bank index, we're nowhere near the 2-month high. So Wells Fargo beginning to show some nice relative strength, volume coming in as well. Celgene, another name in the S&P 500, another biotech, having a strong day today, up more than $3 and trying to break out of this fairly narrow range that it has been in for about the last 5 to 6 weeks. All right, happy Friday, Aaron. We got another weekend in store, and it looks like the market's trying to recover some of the losses from earlier this week.
Absolutely. I'm having to wonder right now if we're going to end up, mostly unchanged for the week, or are we going to end up for the week after the rallies we're starting to see now? So it could be.
I think with the gap down earlier in the week, probably still, it's going to take a lot to get us back up to where we were at the end of last week. So I'm guessing we will finish with a down week, but it is nice to at least see the market recovering, and especially the volatility subsiding, because that's what really spooks the market. Traders start to panic.
Mm-hmm.
That VIX level gets up into the 20s, so I'm kind of glad to see that reversing.
Yes.
I'm sorry, go ahead.
Oh, yeah, no, I agree. I've got some really interesting sentiment to tell everybody at the end of the show, so definitely stick around. There's lots going on those charts.
Yep, we got sentiment coming up. We got seasonality coming up. But before we get to that, we're going to have everything stock charts, and we've got just the right person for it. President Chip Anderson. How are you doing today, Chip?
Hey, Tom. Hey, Aaron. Hey, everybody. I am doing good. Coming to you live from StockCharts headquarters here in scenic downtown Redmond.
Scenic?
Well, yeah.
They talk about that instead of the weather,
See the clouds, which is what we'll be talking about today.
In the clouds. That's appropriate coming from Seattle this time of year anyway. Oh, well. Aaron, I know we've got a bunch to cover, so why don't we just jump into the upcoming schedule and the agenda, and we'll get things going, and we'll have Chip back in here in about 10 minutes or so.
Excellent. All right. Well, next week is going to be a little bit different with 4th of July in the middle, but on Monday, I'm going to give you the monthly DP chart review. So we're going to look at all the monthly charts that just went final. I have a workshop on Tuesday. I have no idea what I'm going to do it on just yet. Working really hard on my ChartCon presentation. So maybe a piece of that, we'll see, but taking your requests. And as I said, 4th of July, no Market Watchers Live, nothing to talk about. And then finally, we're going to have Thursday, Bruce Frazier is going to come on, and as we like to call him, Mr. Wyckoff. So that should be a great presentation. As for today, Chip, as you heard, is here from the mothership in Seattle to talk about cloud investing. It should be very interesting. We have the July seasonality report. Tom's going to give us what to expect in July based on seasonality. 10 and 10 to 1, Johnson & Johnson will be our first symbol. And then finally, as I was talking about, we'll finish up with the sentiment update, which is very interesting today.
All right, well, let's jump into what's going on today. You can see the 10-year Treasury yield, another big collective yawn today. The Treasury market not really doing a whole lot. There was some economic news out this morning, though. May personal income came in as expected, rising 0.4%. May personal spending, however, came in lower than expected, rising 0.2%, market expecting 0.4%. Then at 9:40, we got the June Chicago PMI, much higher, 64.1. Market only looking for 60.1. And then June consumer sentiment came in about 15 minutes later at 10 a.m. Eastern. And that was a little bit short of expectations, 98.2 versus 99. So the bond market kind of took all of that, looked at it, yawned, and we are sitting almost unchanged in the Treasury yield. So not a whole lot going on there, no indications. Although, again, I think when we stretch this out, we look at a longer term weekly chart, it kind of gives us a better big picture view in my mind. And at least visually, that we are still in an uptrend, even though in the short term, we continue to move lower here. I would suspect that somewhere in the 270, 280 range, if we dip that low, that's where we're going to begin probably to see some selling in treasuries and then movement back into equities. Whether or not that's currently or not, that remains to be seen. But we are already seeing some rotation into financials, and maybe that's anticipating a rise in those treasury yields. We did want to point out the S&P 500 here quickly. And first on the daily chart, and you can look at the market a lot of different ways. We can look at it from a short-term perspective, very short-term perspective, intraday, or we can look at it from a buy and hold perspective, look out over weeks and a weekly chart over years. But in this case, the S&P 500 on a daily chart, when we look back, it's just a lot of noise, really. The past 4 months, we have been going up, down, volatility's been all over the place. But literally, if you look back a month, 5-6 weeks ago, we were sitting at almost this exact same level. Go back into the middle part of March, we were sitting at this exact same level. After the huge selling in February and the bounce into the middle part of February, pretty much the same level. So the S&P 500, there's been a lot of noise, a lot of headlines, but really we've just been going sideways. Now, I think in the short term, on this chart, it looks like we've kind of come down, approach support, maybe starting to turn back higher. You can see we're trying to get through that 20-day moving average. Although when you've got a sideways market like this, I think the moving averages really are almost rendered useless because they are trend following moving averages, and or at least that's what I use them for. And when there's no trend in place like we've seen, it's really difficult. And what you see a lot of times is just movement, random, what appears to be random movement above and below these moving averages. But I am interested in getting back above the 20-day moving average because an uptrend cannot exist without prices above the 20-day moving average. So that is traders' first goal, if you will, to try and climb back above that 20-day moving average, which right now is at 2740. Now I'm going to pull up an intraday chart. So kind of remember that on a daily basis, 2740 area is somewhat important. Let's go back 15 days on this 10-minute chart. And I think you're going to see that this is also, at least in the short, oops, that's not what I wanted to do. At least in the short term, I think this area is a major resistance area for the market. So here's a 10-minute chart going back 15 days. And I'm going to annotate this and show you a low that was cleared on a gap down right here. You see that prior low? This was back on June 19th. We tested it June 21st. Kept moving higher, although the overall trend was lower. And then finally, beginning of this week, we had that gap down at 2744-ish. Continued moving lower, got all the way down, printed a fresh low, and with that had a positive divergence. Went up for a while, struggled though, and I'm going to put this line in right at about 2746, and then went back down to a new low, and now we've been in an uptrend again. So currently, clearly since the beginning of yesterday, the past 24 hours or so, we've been trending higher. But I think this overhead resistance here, 2744 to 2746 on an intraday basis is what you want to see as a short-term trader. We could probably draw in a trend line as well, going back over the recent highs. And You can see that if we do that, we come in just a little bit above, let's call it 2750. So as we get back up here, and then we might as well throw in gap resistance as well, which also comes in at 2755. So there is a lot of congestion on a short-term chart that the S&P 500 is going to have to try to navigate here in the near term over the next, well, if this trend continues, we're going to be up against it this afternoon, but maybe into early next week. 2745 to 2755. Let's see if we can get through, because again, this is short-term, very short-term resistance looking at an intraday chart. But if we go back and we look at, say, a daily chart, and I'm going to go a year so we get a little bit more context here on the daily chart. But that 20-day moving average right now is at 2741. And then all of those intraday levels that I was talking about, just showing these last 15 days, came in 2745 to 2755. So this rally is nice off of support, but we've still got some work to do in the near term. Long term, especially if we get out to a weekly chart, you're going to look at 2740 and you're going to say, well, what difference does it make? To a long-term trader, investor, it doesn't matter. To a short-term trader, though, it matters a lot. And so just wanted to point that out. I'm going to go ahead and turn it over to Erin. She's got an upgrade and a downgrade for you, and then we're going to bring Chip back in with us.
All right, let's get started with that. All right, here we go. So we're going to start with an upgrade, GMS Incorporated. And Tom, I believe you talked about this one. Was it yesterday or the day before?
I believe it was yesterday.
Yesterday, yes. And, we were already talking about earnings not coming in very well and all of that. How in the heck did we end up with an upgrade today? But we did. And we've got a giant gap here that needs to be covered. And of course, I've got a PMO sell signal below the zero line. I wouldn't touch this with a 10-foot pole. And honestly, you could look at this and maybe even make a case for a kind of a complex head and shoulders, even heading into July. So not a great one to look at, I don't think, for an upgrade. Very curious why they were, though. That was very interesting. Tenet Healthcare, this one was downgraded today. And yeah, I'm not liking this chart much either, but you can see as far as the scooter, though, we have a lot of relative strength going on here. And OBV, while it is trending down, not too horrible. I'm not happy with the PMO, of course, because we are in a downtrend, but you look at price action and of course it's going to be heading lower, but it is not quite decelerating yet either. So we're at a very important area of support here at $32. And it did dip below that 50-day EMA. So I'd watch this one pretty closely with really good relative strength. This one could end up getting that bounce. But of course, on the downgrade, I don't know. We've got an opportunity here because it is down almost, over 2.5%. So it might be an opportunity to get in on a pullback. But I'd be very careful given that it was just downgraded. And that really completes the upgrades and downgrades. I think it's time to bring in our fearless leader, Chip Anderson.
Good morning, Chip. Welcome back.
Oh, well, thank you very much. I don't know about fearless leader, but I'm a leader of some kind, I guess. We wanted to talk two things today, if we can. First, before I get started, though, I wanted to mention the special. Can I do that?
Yes, absolutely.
So just in case you are unaware, we have a special running for our members. If you're not a member, go ahead and get your free trial, and then you can get in on the special too. But if you are a member and you're unaware, then for the next couple of days, this will be running until July 4th. We're holding our summer special. We typically do specials twice a year, about 6 months apart. And so if your account is expiring anytime within the next, or is up for renewal anytime within the next 6 months, then you might want to consider taking advantage of this special. It's going to get you an extra month of service for free. And it's basically like free money. It's like stealing from us. So go ahead, go for it. There should be a link up at the top of your pages with a button that shows you how to take advantage of that special once you log in. So take some time for that. Anyway.
Hey, Chip.
Yes.
Just to clarify, is that only for renewals, or is that also for new members? That special?
Well, new members would join with the free month of service. And so they can join with that. And then if they want, they can immediately then take advantage of the special. But that would be a little risky. They might want to spend a little more time making sure that they like stock charts before for grabbing onto that special. Again, we usually do specials in the summer and in the winter, 6 months apart. The big one is in the winter with Cyber Monday and all that excitement. But if you're a member and you're expiring within the next 6 months, and you can find that out on the Your Account page, then now's the time. Absolutely.
Awesome.
Okay, sound good?
Perfect.
All right, let me get my screen sharing going. I want to go into my presentation. So today we want to talk about cloud-based investing, and cloud-based investing meaning not investing in the companies that work with the cloud, but cloud-based investing using Ichimoku cloud charts. And so first off, the name, obviously Japanese, and my Japanese is horrible. And so a lot of people get tripped up by that. So I typically just try and simplify things. I try and make sure that the most important pieces of the puzzle are explained well. You can get into a lot of detail with Ichimoku Clouds, and I have some resources, some references at the end of this presentation for the people that want to go really deep. But I'm going to give you a high-level perspective on things, and basically try and keep the nomenclature and the terminology to a minimum. So I'm just going to call these cloud charts from now on, and I'm going to use the English names rather than the Japanese names, because again, my Japanese is horrible. Anyway, here's what they look like. It's this red and green and area that you see streaming through the cloud, and then there are optionally, we'll talk about this, 3 lines, a red line, a blue line, and a green line that you can add on top of this. One of the things that's really interesting about Ichimoku Clouds charts is that they do a little bit of prediction into the future. It's one of the few technical indicators that we have that actually goes and tries to show you a little bit of what might happen down the road. And so people really do like cloud charts for that reason. They're visual, and they have a little bit of a predictive characteristic to them. They're mainly used for visual analysis. In other words, your eyeball is used to figure out how the cloud is interacting with the price bars and how the different lines are interacting. We do have some scan capability with cloud charts, but it's limited. And there's more reference to that at the end of this presentation. But anyway, that's what they look like. Let's get into how they're constructed. Just again, this is more kind of background information. Once you're familiar with them, you don't really need to know how the lines are calculated. But basically, again, they're 5 lines. While you can put the cloud chart overlay on top of any kind of chart, including bar charts and other things, it is recommended strongly that they be used with candlestick charts. That was their original design point, and it makes a lot of sense to use the cloud charts with candlesticks. And as I showed you, there is extra space on the right that's automatically added, and that is for the predictive characteristics of the cloud. Again, the green and red area is the cloud, and it is essentially shifted to the right 26 days. The 26 days is how much that extra space on the right represents. And as we'll see, you can use a whole lot of interpretation with just the cloud itself. That's the first thing we're going to do. And then after we do that, we're going to come back and look at the 3 lines or spans that are associated with the cloud. The conversion line, which is blue, the baseline, which is red, and the lagging line, which is green. And we'll come back to those in just a minute. But these are the formulas for calculating those lines. So how do you create one of these charts on StockCharts? First off, you create a Japanese candlestick chart using sharp charts. I'll have a demo of this in just a second. Then you find the overlays drop down. A cloud is not a type of chart. Instead, it is an overlay that you can add to a chart. There are 2 options now for Ichimoku cloud charts. The first one is just Ichimoku Cloud, and that's just the cloud itself without those additional lines. That's the one I recommend people start with. It really clarifies things and keeps it from getting your chart from getting too busy when you're starting out with this stuff. And so if you select the cloud option and then click update, and the overlays drop down, you'll see what I'm talking about. And this is an example of one taken from yesterday. XLK, the technology sector. This is just the cloud without the lines. And so what we're starting to be looking at is the interaction of the candlesticks with the cloud itself. Also the color of the cloud. When the color is changing, and then also how the candlesticks interact. So you'll see the cloud represents, can be used to represent support and resistance. In the most general simplistic analysis of cloud, that's what you're looking for. Use the cloud for support and resistance. A green cloud, it means that the stock is in an uptrend. A red cloud means the stock is in a downtrend. Obviously, as you can tell, the price bars will move across the cloud. When the price bars are inside the cloud, it represents indecision. That's the standard, typical kind of no-brainer approach to using these things. So here, just to put it into words, typically you use cloud charts with daily charts. And if you're doing that, then they will give mid to long-term signals. So they'll give signals that are good for a couple of weeks to a couple of months, depending. As I mentioned, the cloud itself is a support and resistance area. Prices above the cloud mean we're in an uptrend. Prices below the cloud mean we're in a downtrend. If the cloud's green, then the uptrend is strong. If it's red, the downtrend is strong. And as I mentioned, prices within the cloud, it shows indecision. In other words, it shows sideways movement. Another thing that's very interesting and something to keep in mind is the width of the cloud. As the cloud gets wider, then these signals are stronger. All of this, of course, is a very subjective, not objective type of analysis. But those are the standard rules for looking at the cloud and kind of figuring out what the cloud is meaning and telling you. So let's look at this one. Here's the industrial sector, which has been a little more in a downtrend recently, a longer term downtrend, and we can see more red on this chart than we saw on the technology sector. The technology sector was generally an uptrend. We saw lots of green. At this point, we were seeing green up until about the middle of March. And then we got our first little batch of red, a lot of indecision, and then we got some more decisiveness of red. And then interestingly, looking into the future, the cloud turns green again. And we'll have to see if that comes into play. But anyway, so that's just a quick and dirty illustration of the cloud there. Here's the cloud with a stock. We'll pick Apple. I would say generally an uptrend because we see lots of green, a couple of periods of indecision with the red, and also we see the cloud or the prices bouncing off the cloud in a couple of cases in some really nice ways. So here was a bounce recently off the cloud, bounce down here off the cloud, and it happens in both ways. We see a gap kind of moving through the cloud in this case. So lots of interesting signals being generated just by using the cloud itself and not any of the additional lines. Time for a quick demo. So I'll just go over here. Starting at the members workbench, the cloud stuff that I'm showing you is part of our Sharp Charts tool. So of course you just get to Sharp Charts by typing in a ticker symbol or clicking on a ticker symbol, and now you're on the Sharp Charts workbench. This is where all the work is done. Here's my standard settings for a chart that I typically look at. To turn this into a cloud chart, we're going to do a couple of things. The first is we're going to take this and turn it into a candlestick chart. I also want to get rid of the red and the black, so I just turn this down color to black. That will do that. We don't need volume for cloud analysis. And then in the overlays, here are the two settings that I was mentioning. There's the cloud by itself, and then the cloud with the additional lines. I'm going to choose cloud by itself. And when you're using the cloud chart, you typically, you don't have to use other indicators, so I'm going to get rid of my MACD. And so now I hit update, and we see the kind of chart that I was just showing you a minute ago. There we go. Those are the settings. And now I could save this as a chart style. I can make it my default chart if I really liked it. I can put it into little buttons, or I can just simply type other ticker symbols and have it immediately show me what's going on there. So Amazon is looking pretty green. Amazon has a very green cloud. So that's the quick demo. All right. So as I mentioned, there's the other setting that you can use that has the additional lines. And so that's the full cloud chart. And so here's an example with the additional lines. This is the same example we looked at a second ago with Apple. And we see the lines make the chart a little busier, which is why I don't start out with these. You use the Ichimoku Cloud full in the overlays dropdown. But now let's talk about those 3 lines and what they mean and how you interpret them. They're called span lines, and I call the signals that they generate span signals as opposed to cloud signals. So the first thing is the red and the blue lines. The red and the blue lines are called the conversion line and the baseline. And their interaction is something else that can be really interesting and give you some nice signals to consider. First, if the blue is above the red, it's considered bullish, and if the red is above the blue, it's considered bearish. These are generally shorter term signals, possibly week long, maybe up to a month long. But you can get even shorter signals and more interesting signals by comparing not only the red and the blue line to themselves, but also the red and the blue line to their position of the cloud, to the relationship of the cloud itself. So if blue is above red, which we just said is a bullish situation, but that's also above the cloud, then it's more bullish. If blue is below red and it's below the cloud, then that's more bearish. So it's not just this relationship here, it's also the relationship to the cloud itself. So here's an example on that, going back to the Apple chart. We see the blue line up above and the red line down below. Blue above red is generally bullish. In this case, it's above the cloud, so it's nice bullish. However, at this point where I circled in yellow, the lines crossed. Okay, and so that was a bearish signal, but it happened above the cloud, so it's not super bearish. Does that make sense? Similarly, it took a little bit of time for the two to unwind, but here is where red moved back above blue as well, and that was a bearish situation. They crossed back, and this was bullish. They crossed back again, and this was bearish. Took a little bit of time for them to straighten things out, but they crossed here. Blue above red is bullish, and blue above red above the cloud is bullish. And now recently they've crossed back below. Blue below red is bearish. Still above the cloud, so not the end of the world for Apple, but getting there. So you kind of see how that works. That's how that works. That's the most important thing. So you get a lot of different signals with the clouds. The final line I have to talk about is the green lagging span line. Now this line, I'm a skeptic of. I'll be honest with you. I'm not buying what this line is selling. But anyway, first off, let me just tell you what it is. It is literally the price movement shifted back, I believe, 26 candles. So if I turned my chart of Apple here from a candlestick chart into a line chart, you would see the exact same line that you see here in green, only you'd see it shifted forward 26, so that it was current. So this green line is a line chart of Apple shifted to the left 26 times. And as I researched it, it says that it's used for finding support and resistance areas, which it can easily do. As you see, I've drawn here a nice kind of support and resistance area looking place with my yellow trend line. I'm matching up this peak here and this peak here and this peak here and this peak here. They all match up quite nicely, but it's a lie. It's a bit of a lie because again, this is the same as this only 26 days earlier. So the fact that this peak and this peak line up is not relevant. That's always going to be true. The fact that this peak and this peak line up is also going to always be true.
Hey, Chip.
Yes.
So if I use a chart like this, can I trade 26 days ago?
You absolutely can. I think your broker might have an issue with that, but that's your challenge.
I'm trying to figure this one out.
Yeah. So I'm not, again, the green line, not fully getting it. Maybe I need to go back and read the books a little more, but it has been used or is said to be used to help find and make us support areas more obvious. I like the cloud itself. And the red and the blue lines are interesting, but I think the most important thing to me is the cloud. As I mentioned, this can be a self-fulfilling prophecy with this lagging span. Anyway, so there is a lot more information up on the web. We have a great Ichimoku article in Chart School. And so you can just go into stock charts and hit the search and find that article by typing in cloud chart or typing in Ichimoku. And then you can go to our store and also search for Ichimoku. You'll find these 2 books. They're great books. They've been around for quite some time. There are actually a couple other books that are out there as well. The bottom line here is we love any kind of interesting way to visualize what's going on in the market. That's what StockCharts is all about, visualizing the market. And clearly, cloud charts are a very new, or very different, I should say. They're very old, actually, but they're a very different way of visualizing what's happening, kind of maybe confirming, or if you think you see something in a chart, then add the cloud to it and see if the cloud causes you to, if it confirms what you think you saw, or if it maybe challenges what you think you saw. I think that's its biggest, most useful aspect. So anyway, with that, I'll open it up. Did we have any questions?
Yes, we actually do from the chat room. I have a couple. The first one, is there a way to scan charts where the future cloud is just turned green?
Nope.
Nope.
The scan engine doesn't know about the future. It has no knowledge of the future. It'd be kind of nice if we could scan for the future. That'd be wonderful. Show me all stocks that are going up tomorrow.
Exactly.
But no, the scan engine, as I mentioned at the start of this, has limitations when it comes to the cloud, and it has no knowledge of the future. You can scan for what the cloud is currently doing, where it's currently at right now, but the future stuff is not going to work.
Right. I'm sure it's in those books, and I don't know if you just happen to know, but what's the historical accuracy, like percentage-wise, on the predictive ability?
So this is a subjective approach to chart analysis, and I don't know if there's any way to quantify its ability. That's like asking what's the success rate of trend lines.
Right. Right.
The goal here is not to come up with an automated trading system. The goal here is to help you visually analyze your charts and have you become more comfortable with where you think the stock is going.
All right. Well, those were the questions from the chat room. Did you have any to add, Tom?
No, do not. It was a great presentation. I know we get a lot of questions overall on the clouds and how you use those. So I think it was very timely, Chip.
Yes. A lot of surveys, a lot of people, hey, talk about Ichimoku. And
there you go. Well, I appreciate it, everybody. I hope this helps. Again, if it allows you to visualize the market better, then that's the goal. Thanks, everyone.
All right. Appreciate it. Thanks, Chip. Okay. Well, we shall move on. I believe we've got some seasonality to talk about for the upcoming month, July. That, of course, starts next week. This is the last trading day of June. So what I'm going to do is I'm just going to run you through some stats real quick. I won't bore you too long, and then we'll start taking a look at some things on the site. But while I'm talking about that, you can take a look at the S&P 500, because that is what I'm going to talk about as we head into the month of July. The first thing I want to point out is that the S&P 500 over the last 68 years has moved higher during the month of July 38 times. It's moved lower 30 times. So a little bit better than 50-50 odds that we're going to see a higher price on the S&P 500 at the end of the month. The average or the annualized return of the S&P 500 over these past 68 years in the month of July, 12.38%. And that ranks July as the 5th best of the 12 calendar months for the S&P 500. Now, before you get too excited, keep in mind that on the NASDAQ, July has risen 25 times. It's declined 22 times. And the annualized return on the NASDAQ for the month of July is only 2.62%. And that ranks 10th out of the 12 calendar months, with only August and September being worse months for the NASDAQ. The Russell 2000, we've got data on that since 1987. Over these last 30 years, July's been up 15 times, down 15 times. So it's literally been a coin flip for the small cap stocks. On an annualized basis, the Russell 2000 has lost 6.24% in the month of July over the past 30 years. And that ranks July as the 11th best month out of 12, with August being the worst for the Russell 2000. So that just kind of gives you a little bit of overall big picture history. Let's talk a little bit about the S&P 500, though, and how it breaks down during the month of July. The 1st through the 17th are bullish. Those are bullish days. Not every day has an annualized return that's positive, but most do. And the annualized return for those 17 days, July 1st through July 17th, annualized return since 1950 is 23.94%. And there's been about a 58.3% chance of a day during the 1st to the 17th moving higher, going back to 1950. Now, how does that all compare? Well, the 23.94% annualized return during the first 17 days of July is more than double what the S&P 500 typically does throughout the year. It averages about 9% a year. So there's definitely a bullishness, a historical bullishness during the first half of July on the S&P 500. And the fact that it's moved higher 58.3% of the days in this period is also somewhat significant because the S&P throughout the year moves higher 53.5% of the days. So you've got a little bit more, 5 percentage points higher chance that you're going to have an up day in those first 2.5 weeks in July relative to the entire year. The 18th to the 24th is one of the worst weeks of the year historically. And I know a lot of people say you go away in May. I don't participate. I don't think along those lines at all. I do think that the May to October period is weaker than November to April. I've got numbers, statistics that prove that out. But I think too many people just use that as an overall blanket to get out in May. And I think that is really a bad choice. I mean, I've been talking for the last 3 months about the dollar rising and how that typically impacts small caps to the upside. And May and June are both strong months for small caps historically. And we've seen, I'll pull up the Russell 2000 here for you, but you can see over the last few months, even though the S&P's been struggling, we talked about that earlier in the show, the Russell 2000 has been performing extremely well. And this isn't just this year because of the dollar. I'm telling you that historically, going back the last 3 decades, May and June have been good months for small cap stocks. So just to make a blanket statement to go away in May, I think is completely irresponsible. And I think most of the media outlets that like to throw it around don't do their own research, and it just sounds cool and it scares everyone. So it probably drives ratings up. But you really have to dig a little bit deeper. Now, what I would say is that from mid-July through the end of September, through about the 27th, 28th of September, that truly is the worst period of the year for the stock market. You can go back and it's true across the S&P, the NASDAQ, and the Russell 2000. So really July 17th is kind of the go away period. If I was going to go away, it would probably be for those 2 months and 10 days or whatever. So keep that in mind as we get closer to that July 17th period, or July 18th period. July 18th through the 24th on the S&P 500, that week has produced an annualized return of minus 19.29%. And I couldn't help but see 1929 and think about the crash. I don't know, maybe it's just me, but that was kind of odd that the percentage comes out to 19.29%. But that is a negative annualized return for July 18th through the 24th, and that goes back 68 years for that week alone. 25th through the 31st, though, we tend to rebound, and the S&P 500 has an annualized return of 19.51% in that final week of July. So that's kind of a breakdown of the S&P throughout the month of July. Again, the first 2.5 weeks tend to be pretty strong. We'll see whether or not that's the case. Looking at some of the sectors, and I'm going to go ahead and now show you some charts here. Let's take a look at seasonality. Financials. Financials are the best sector, have been the best sector on the S&P 500 over the last 20 years. And here you can go back these last 20 years and see that the actual performance on the XLF is 1.1%. That means we average going up 1.1% during the month of July for the XLF over the past 2 decades. We've gone up 63% of the time. So if you literally just take the XLF on June 30th and the XLF closing on July 31st, if that being the only time you would trade, if you did that over the last 20 years, 63% of the time you'd have made money. So 63% of the time, July ends the month above where it starts for the XLF. Another way to look at this is to compare the XLF to the S&P 500. So this is a seasonality of how the XLF compares to the S&P. And if you look at it, It's actually outperformed the S&P 500 slightly more than 50% of the time, but it has averaged outperforming by 0.7%. So where the XLF, I showed you, averaged 1.1% per month in July. If I pull up the S&P, it's going to be 0.7 lower. It should be 0.4. So let's pull this up and go back the last 20 years. Actually, I'm showing 0.5. Maybe it's a rounding. But that's the difference, and that's what you're looking at there. All right, so what sectors tend to underperform in the month of July? Well, energy, and energy's been pretty strong, but this is the weakest sector historically over the last 2 decades versus the S&P 500. So it has outperformed the S&P 53% of the time, but the average return is 0.8% below the S&P 500. And when you look across, really the only other month that is as bad as July for energy is October. The other group that tends to underperform is utilities. And over the last 20 years, you can see utilities underperforms by 0.7%. All right, let's talk about some industry groups that perform well. Let me pull up the first one. Aaron's been talking about, and I think also Arthur, when he was on, talked about REITs doing pretty well, and starting to look better technically. Well, oops, I meant to do that on a seasonality chart. My bad. And yeah, there we go. So the DJUSDT, which is one of the REITs, you can see in July has gone up over now this is only 11 years. It doesn't go back 20 years, but over the last 11 years, July has been up 90% of the time. So essentially 10 of the last 11 years. And the average return during the month of July is 5.2%. So this is an industry group that does extremely well. So let's take a look at the chart. See what the chart tells us. This is the diversified REITs, by the way. But this is what both Aaron and Arthur were talking about. We got a recent breakout, nice volume coming in on the index here, continues to push higher. PPO looks good. This is a group that I think is looking pretty good technically as we head into a month where we tend to see some nice strength here. Also, I'm not going to go, pull up all of the seasonality charts, but I will tell you that another area of the REITs that tends to do really well in July are the residential REITs. And if you check this out, we're trying to make a breakout today, and we've been trading above the 20-day moving average. So another area of the market that looks good. And then finally, I'm going to pull up the biotechs. Of course, this is not in the financial space, but biotechs are one of the best groups as we head into July. This group was really looking good until the last 5-6 days. You can see we had a number of down days in the biotechs, pulled back. So it really messed up the daily chart. The weekly chart, I think, still looks fine, but the daily chart had broken down. We're trying now to get back and repair this chart, get back up above that 20-day moving average. But what I'm going to do, just to give you one final thought in how you can, you can't really scan necessarily for seasonality, but what you can do is scan and find a group and then pull up seasonality charts. And I'll show you what I mean by that. I have set up, if you go down to my list, my chart list down here, I actually added one, biotech seasonality. And right now there are no charts in it. I just did this, created it to save a little bit of time. But all you have to do is hit add new list and type this in, and it would show right on your screen of your chart list. But I want to go in and let's set up a new scan. And I'm going to up the volume here. 40,000 is too low. I don't even want to consider. I'm just going to go with 500,000. So, and I'm going to go back over the last 90 days. What this is doing, first of all, is it's going to limit as I add more criteria. It's only going to consider stocks that over the last 90 days has an average daily volume in excess of 500,000 shares. I don't want to look at stocks that don't trade much. Now what I'm going to do is I'm going to add, let's go into sectors and industries here. And if I go down to healthcare, here's biotech. So if I click on that and add it, now it's going to scan for biotech stocks, meeting the same criteria on volume. And then the other thing I thought I would do is, we've talked a lot about scooters. Let's pull up the scooter rank, add that, and the default is scooter over 90, but I'm going to lower it to 70. I'm not sure how many stocks I'm going to get here. But let's take all biotech stocks that have scooters over 70 and have average volume of more than 500,000 shares per day. And let's see how many we get back here. First, let me just check syntax. Okay, it's good. So I'm going to run the scan. And when I run the scan, oh, here we go. Okay, 42 stocks. That's not a bad list. So now I'm going to replace my existing chart list with these results. So it's going to ask me which chart list, and now I'm going to go find that biotech seasonality. Okay, so there it is. I click OK, and now those 42 stocks that I just scanned for are in this particular folder. And you can see the scooter. I can rank it by scooter, and you can see which of these stocks has the highest scooter all the way down to the lowest. And you can see it cuts off at 70. And then I can pull it up in seasonality view. And I could go through each one of these. And then, so here is, so I already know all of these stocks in here have scooters above 70. I know that they're biotechs. I'm looking at biotech specifically because I know biotechs tend to do well in July. And I know, because these stocks do have scooters over 70 and they are liquid, that they're going to have pretty decent technical charts. I haven't looked at the charts yet, but with a scooter over 70, I'm thinking they're probably going to be in pretty good shape. So what I'm doing now is just looking to see how the July seasonality lines up. This particular stock doesn't follow the pattern for biotechs, so I'm going to skip it. Let's go to the next one. ADVM only gives 5 years. I mean, look at the numbers are all over the place. I'm going to skip that. Let's take a look at Amgen. Now, this is a big name, probably one of the biggest, if not the biggest in the space. And look at July. 84% of the time over the last 20 years, Amgen's gone higher in July, and it averages going up 10%, 9.7%. That's a huge seasonality, at least I think huge seasonality looking back the last 20 years that you should consider if you're looking at potential trades in the month of July. Now, let's take a look at Amgen on its chart to see what it looks like. Well, it just bounced off the 20-day moving average. I think it's been trading pretty good. Clearly, if we go to a long-term monthly chart, you've got a great performer here with Amgen. It's been one of the best biotechs. So Amgen definitely seems like one of the stocks that I certainly would consider in my portfolio. Another one that I'm sure the scooter would not allow it to be in the sample that I just talked about. But Celgene, I mentioned earlier in the show, was threatening. Now, it hasn't quite made it yet, but it was threatening to break above 80. And so Celgene, let's say it makes the breakout at the end of the day. We could pull up the seasonality on Celgene. Look at Celgene in July. 74% of the time it goes higher. It averages 6.7%. And when you look across the average monthly returns, July has been the best performing month for Celgene. So you can find a lot of possibilities looking at charts like this. I think I had mentioned Vertex earlier in the show and the fact that it was a strong June performer. So let's take a look at Vertex. And you can see June averaged 7.3%. Only went up 55% of the time. But when it does go up, it tends to go up really strongly, obviously. But July is more flat. So Vertex doesn't seem to have the same historical tendency as we move into the month of July. So that was a different way. I mean, I went through some of the different indices, give you some updates there. But let's take a quick look at the summary of what we just talked about. And there were some individual stocks. I will throw out there, as you're looking at the things we just talked about, I will throw out there 5 Dow stocks that I noticed performed pretty well during the month of July. Caterpillar, Cisco, Goldman Sachs, a financial, and we talked about financials, best performing sector in July. IBM, and another financial, JP Morgan, JPM. So those were some possible trading ideas as we move forward. And that's it. That summarizes the
All right.
report for
Hey,
July.
I did get a question for you.
Okay.
Let's see. Is it better to wait to buy at the beginning of a new month or at the last day of the month?
I would always want to be in ahead of time. I think historically, the 28th through the 31st tends to be a good period for the market. That's what my long-term analysis tells me. So if I were trying to pick out the time of the month to buy, I would be buying around the 27th of the month.
All right. Yeah, I know you've done quite a bit of studies on which day of the week and all of that. I've always found that very interesting.
Yes, and the time of the month is really important, and I think a lot of it has to do with money flows, and that 28th to the 6th period of every calendar month. And I'm not trying to say that every month from the 28th to the 6th we're going to go higher. That's not what this means. There's plenty of periods that go lower. I think we could probably look back in 2018 and see months that it didn't work out. What I'm talking about is a long-term, really big picture view of the 28th to the 6th, and that has a much stronger tendency to move higher than other parts of the month. And the 18th to the 25th or 26th has a much stronger tendency to move lower than any other period of the month.
Goodness. All right. Well, I'm ready to do the 10 and 10. Are you about ready?
I'm ready.
All right. Let's get this going. We had quite a few requests. I thought it was interesting. I always like to look at what sectors we've had requested. And a lot of cyclicals and technology right now. And I know that's an area we've been looking at as, possibly improving over the next few months since it has been hit so hard. So let's go ahead and start with Johnson & Johnson, J&J.
All right, J&J, well, it is in that healthcare area. It's been downtrending for quite some time. But let's get a quick look at the chart here and see. Yeah, you can see that the PPO here for the past 5-6 months has remained below the center line or the zero line. Anytime you've got a PPO in negative territory, you generally have a downtrending stock. I mean, it's really hard to uptrend with a PPO that's in negative territory. So I think that I would continue to watch the downtrend, look for a heavy volume break maybe to the upside above this. Oops, that's not what I wanted. If we could break out, say, above the trend line that was established, I think if we go back to the highs in March here and draw a trend line coming across, I think you'll see that we've got fairly substantial resistance coming in, maybe at about that 124 area to watch. And if I drew in a couple of support lines, major support back at the beginning of April, right there, and then we also had some earlier lows. Maybe right about in there. I'm going to say 124, 126 area is where, and then you can see that's where the last rally attempt failed, about 125. And then you've got the trend line coming in at 124. So J&J is not a favorite stock of mine, but I do think maybe we could start to see some absolute strength and maybe even some relative strength if we could break this area of resistance around 124 to 126.
Okay. And let's see, our most popular in the chat room, we actually have a tie, so I will probably be including the second one at the end of our list here. But most popular, I'm going to go with is Square, SQ.
All right, Square has been a great performer, obviously, along with a lot of the other higher risk, plays where we've seen a lot of movement to the upside. Square's been pulling back, but I think it's presenting an opportunity. I think that I know this was scary back in March, and then again later in April, the declines that we saw. But anytime you get a stock that's moving up fast, you've got to be prepared for the volatility to the downside as well. I mean, you're not just going to go straight up all the time. So I would be looking for a couple of things. Number one, I think your key resistance previously was at about 57.5. That now becomes support. Even though we've been weak of late, we haven't really tested that area. And also we've got the rising 50-day moving average coming up just beneath that. So I think that we could consolidate for a while. One thing that bothers me a little bit here is on the last breakout and this move in early June, I think the volume was just kind of so-so average. If you look back, the move that we made back in February and March, look at the volume. Seemed to be a lot more accumulation. This seems to be slowing down. So I think we could be in for a period of consolidation on Square, but I would look maybe 57.5 to 68, 69 to the upside. I guess I could throw that in here. Maybe somewhere in this trading range over the summer. All
right. Let's look at one in healthcare. It's actually been it was in the news today, Novartis, NVS. Apparently they're going to focus more on prescription drugs, and they're spinning off Alcon I, which of course they had purchased back in 2011, and it pretty much failed for them. So now they're spinning it off and getting ready to do a $5 billion buyback.
Yeah, I would say here you've got gap resistance from the gap that took place back in back in mid-June. You can see the volume had picked up on the selling here. Maybe that'll turn out to be a little bit of capitulatory selling, although the volume should be heavier for that. But the overall downtrend still bothers me here. So it's kind of a little bit like Johnson and Johnson in that, and maybe you could make an argument that this gap is clearing the downtrend. We do have good volume, but I don't like that black candle. I'd like to see not only a gap higher, but I want to see the stock push higher throughout the trading day, in addition to the gap. So I'm going to just say maybe right around this 76 area is going to be key resistance. We had support down close to this zone back in the latter part of April, early May. And then once we moved below, you can see all the failed attempts right around 76. We gap up, and here we are. Looks like maybe failing at 76 again. So I like the fact a short-term positive is breaking this downtrend line. I think we still got work to do. Let's get a definitive breakout above the 50-day and above resistance around 76, 76 and a quarter, and then maybe I'd be more interested here.
Okay. From the pipelines industry, Enable Midstream Partners, ENBL.
All right, ENBL, not a whole lot of volume. I guess 164,000 so far, roughly at just past the halfway point of the day. Be careful if it loses the 20-day moving average, because I'm not a big fan of trading stocks that have broken out with a PPO that is as decisively negative as this one is. Also, on the breakout volume, I'm not really seeing any huge spike in volume. I mean, it was okay. And now we're coming back down. And as long as we hold this rising 20-day, we're fine. I think if we close below the 20-day, then I think we could begin to open up a 50-day test, which was down at 1550. And that'd be almost 10% lower from where it is right now. So I would keep a closing stop at the 20-day.
All right. From the banks, one we haven't looked at in a while, Ally Financial, ALLY. Huge gap up today.
Yeah, I think the whole space, this is a little bit similar to what I was just talking about. It looks like it's breaking out. This one could use a little bit more volume on the breakout. I am still believing in this space because I still think the dollar goes higher. I think interest rates go higher. And as a result, I think many of the financials, especially small financials, will do really well. But we have to see that technical strength. I mean, I can talk about fundamentals all I want, but if we don't see it showing up in the charts in terms of price action, I wouldn't play it. So here we are getting a nice gap up. Volume is certainly improving a little bit, but let's get through the most recent highs. I'm going to just connecting here at the top of this recent high candle body, and then the intraday high that we saw on that shooting star candle from a little over a week ago. So I'm going to say 26.85 to about 27.10 is key resistance. I mean, the problem is when you're in a downtrend is you're just going to stair step all of your resistance levels. I mean, you can just see them lining up one after another. And so you got to start making your way, and there's going to be overhead supply that you're going to have to deal with and so forth. So I would just say that for this stock, it does look like it's beginning to strengthen. I do like fundamentals in the financials. Just talked about the seasonality, but let's first get through these two levels of resistance. We get through 27.10, 27.15, get some volume coming in, and I think we may start to see an uptrend evolve.
Okay. This one has a really nice setup on the RRG, the short-term one, the daily one. ChemMed Corp, CHE. I looked at it too, and even though the PMO is in decline, it does look like it's ready to turn back up. So it'll be interesting.
Yeah, I like, well, first of all, you get these huge uptrends. I mean, you have to assume that you're going to go through periods of consolidation. If you're chasing and you get in at the top, this is very frustrating to see your money just slowly moving downward. But I will say that we've got a pretty well-established channel here. There's the tops, and if I just drag this line down, this is kind of the, that's essentially the channel that we're in. So I would like to see volume pick up on a breakout, but I think the PPO being back down to the center line is a positive. I think what it's done is it's allowed all of this, overbought look how overbought we were. We're now back down under 50 in the 40s. I agree with you, Aaron. I think this one's poised to make a run. I think confirmation to me would be a breakout of this channel to the upside with increasing volume.
Yep. That's always interesting to see when I look at the RRG versus the chart, just to see what it's coming up. And it does happen like that quite a bit. All right, the next one, I love this symbol, the cybersecurity ETF HACK, HACK.
Yeah, that when I'm having a bad day, that could also apply to my golf game.
Was that yesterday?
Actually, I played really well yesterday, but don't want to bore everybody with that. The most recent low on HACK, after this push, we broke out to a new high. We pulled back a little bit and then broke out again. So this is a level that I'd want to keep an eye on to the downside. We are below the 20 and the 50. So in the short term, things have started to turn a little bit more bearish, but I think it's just sideways consolidation. I still think we have an uptrend in play. So I would look for 36 to hold, and I believe eventually we'll make another run for 39.5. So I would be bullish, and we're already toward the lower portion of this trading range. And the closer we get to 36, the better I like the reward to risk here.
All right. How about Canada Goose Holdings, GOOS?
Yeah, this one I believe is on my strong earnings chart list. And I think recently they came out with, out with strong earnings. I love it in this gap support zone and close to the 20-day moving average. So for me, the tail that came down here, you can see, I'd like to see that hold because that is just below the 20-day moving average. If we fail to hold that on this kind of volume, that's where the buyers came back in at about $53. So if you move below that low, I think that's where you're going to see a lot of stops get triggered. Stock could fall pretty quickly below that level all the way down. So this would be my intraday stop. And as we got closer and closer to the 20-day moving average, the more I like it. I love the heavy volume push to the upside. A stock I know going from 45 to 67 is kind of hard to swallow, but as it pulls back and consolidates and you unwind being way overbought, I think that is where it sets up the opportunity to go back up and retest the prior high. So that's the trading range that I would consider on Goose. I like this one.
All right. The next one is, mostly a new stock. So there's not a whole lot of history, but it was very much requested in the chat room. Dropbox, DBX.
All right, DBX. Well, it's kind of returned to the scene of the crime here. It broke out above $32, $32, $33, let's call it. Came all the way back down. I love that candlestick, though, the reversing candle. That was a nice bullish engulfing candle. Volume picked up a little bit on that, but I think that was a good move. We're trying to get back through the 20. So I think short term, we're trapped between the recent low and that 20-day moving average, which we just failed at today. So I'm going to just kind of draw in right here. That low, I think, is very important. And the high, the open today is important. That's about a 10% range. I mean, it doesn't look like much on your chart, but that is about 10% between, say, 31 and 34. Let's see which way it breaks first. My guess is we're going to break back to the upside and then make a run back up for 42. But we'll see. I like it. I think it looks pretty good here.
All right. Our last one is an ETF, the Transportation Average ETF, IYT. Nice bounce for me. I'm looking at the 200-day EMA, and it's passed its test. It held that support.
Yeah, I love the fact that it held support. I love that doji off a downtrend. That is a pretty good signal of a reversal, and we're getting that today. We've got some overhead resistance. If this is truly a long-term downtrend, then we'll probably fail at the 20. I don't believe it's a long-term downtrend. I think we came back down to support. It held. I actually wrote about the transports in my blog earlier this week. I don't remember, 2-3 days ago. And I mentioned that the transports were approaching some key support. That is the low candle body that you can see there from back in February. And then from a closing standpoint, you can see more lows. We got close. We didn't quite get all the way down there, but we got pretty close off of some pretty serious selling and now making a turn back to the upside. I expect transports are going to wildly outperform utilities from this point forward as we head into July. We'll see if I'm right, but I still believe we're in a bull market. And the reason I'm saying that, I'll go ahead and wrap this one up and just show you one other chart real quick. But the transports versus utilities had hit a pretty important area of support. So let's pull this up And actually, I don't want to show a candlestick. But if we go back just over the last year, you can see right in here, we'd come down to this double bottom. Actually, we went just below it, and we're now starting to turn back up. I think that's going to continue. So this underperformance over the past 2 or 3 weeks, we've seen a lot of money rotating into defense, which is fine when the market's pulling back. I don't care about that. What I care about is when the market starts to move higher. I think we're going to move higher in July, and I expect this ratio to start to turn or continue to turn back to the upside. So I like the transports. I like IYT. I think we have a good chance to make a run. I don't know if we'll make a run all the way back to the high we had at the beginning of earlier in June, but I do suspect that we'll make a run at least for the moving average that I pointed out on the IYT chart.
All right, that concludes the 10 and 10. And here are the symbols that we did for Tom. And you can find all of those charts that he did and annotated in the Market Watchers Live blog. You'll find the link at the top of the blog. And of course, I have the link in every single recap. So you might want to go check that out. And then you could save those charts for yourself. All right, we'll be right back with the final market update after this short message.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.
All right, let's get started on our final market update. We can see that all the indexes are up today. It looks like we're pulling back slightly after hitting intraday highs for the Dow, S&P 500, as well as the NASDAQ. S&P 400, same thing. We hit those highs earlier in the day, and we are pulling back slightly. Russell 2000, while up, has pulled back and taken back about half of the gains it had earlier in the morning. Canadian markets, big gap up and mostly consolidation going on right now. TNX Treasury yields are down, currently reading at 2.84%. UUP, giant gap down and is continuing lower. Does look like we're getting a deceleration here in intraday, but we'll have to see if it can hold up with that. And if you go here and look at gold, we are seeing that reverse correlation going on here with gold having a really great day, moving all the way up. We're looking at 119, but currently reading at 118.89. Commodities, big gap up, forming a flag. USO oil is still rising, and we can see a gap up on the open. We're sitting at about 1502 right now for USO, continuing its rise. And finally, the VIX, we had seen it reach all the way up to that 19 reading range yesterday, but we've been pulling way back here, and we're seeing, readings now around 15. 14.5 was our low on the VIX today. And that completes our final market update. Tom, did you have something you would like to add?
Yeah, sure. I'm going to go ahead and just pull up the transports real quick and take a look at that index. I'm going to look at the absolute. I just pulled up that transport versus utilities 1 second ago. So let's pull this up now and show you the transport. So this was the move back down recently. And if I go out actually even further, 10,000 was a pretty big area on a breakout. And let me stretch this out just a little bit so we can go out 2 years. We'll definitely be able to see it from there. But if you look at the transports, here was the breakout above 10,000. I thought this was really important. So let's annotate this just so everybody can see it. But notice that when we got up to, in October last year, 10,200, we pulled back. And then we made this breakout in December and had a huge run on the transports. And we've pulled back and have been holding just above this 10,000 level on each of the pullbacks. Now, we were starting to show a lot of strength as we went into June, but the last 2 weeks, we've seen a lot of weakness on transports. But I can't emphasize this enough. I think we have great support down near 10,000. So as we get close to this level, I think trading the IYT makes a lot of sense, because I do think we overall have an uptrend in play. We got great support just above 10,000. And so getting into the IYT close to support with a lot of potential overhead action, all the way back up to about 11.4 or so, I think there's room on the transports to the upside. So I do like that IYT possible trade.
Yeah, it's looking pretty good for sure. All right, let's get started with our decision point sentiment report for the week. All righty, here we go. All right, so this is my list of sentiment charts. Obviously, I'm not going to go through all of them. You can get the sentiment charts, the sentiment indicators, by going to the decision point chart packs. It is in the chart packs. Just go to your account and you can download the indicator chart pack, and that's where you'll find our sentiment charts. I'm going to start with our 10-day moving average of the put-call ratio. All right, so it's a put-call ratio, and a lot of times with the ratios, you'll see we do bull-bear ratios. So we get a little bit of an opposite look here because we're looking at put calls. So you have your negative on the top and your positive with the calls on the bottom. So I have this just so you know what we're looking at. Very important, we've had a bottom now on the put-call ratios, and we're heading all the way up toward the top of the typical range for the CBOE put call ratio. And so what I decided to do, because we still have some more time to move up here, we still could use those readings to get closer to what I would consider overbought in quotation marks. So I decided that I should mark previous tops. We are still rising. We haven't topped yet on these indicators, but I thought I would mark a few of the times we have topped. And as you can see, generally coming in before a rally. There might be a little stumbling to begin with, as we saw back here, but the fact is, generally when we get to those tops on the put call ratios, that's when you're going to generally see those rallies start up. So the idea being that this ratio gets higher and higher with the puts on top. That's where you end up getting, like I said, the bear that is on top and the bull is on the bottom. So the bigger the bear, the higher the number you're going to see here as far as the ratio goes. And we're now at an even 1. So we're looking at an even amount of the put call ratio there. So I would look at these as currently we are starting that rise. So I would say we're in neutral territory, especially when you look at the equity put call ratio, neutral territory and rising. So I think that still looks good for the market as far as, the more bearish people get with sentiment, it's contrarian. So the more investors get bearish, that becomes bullish for the market. So I'm seeing it rising, but sitting mostly neutral, like I said, even at a reading of 1 for the CBOE put call ratio. So I'm going to be watching for it to move higher. So we're in neutral to somewhat bullish because we are starting to rise into that overbought territory for the put call ratio. This was the chart that I oohed and awed over this morning when I looked at it, and that was the AAII investor sentiment poll. Let's see if I can make this a little bit bigger there. And I was oohing and aahing because we had a preponderance of bearish sentiment out there as far as the American Association of Individual Investors. So this is a poll. You just go to their website and you click, I'm a bear, I'm a bull, and it pretty much, they tally it up and we get those numbers on Thursday night. So what is very interesting, we were already seeing a bit of an increase in bears and a decrease in bulls last week, but now we're seeing a really large bearish reading. And I've marked the other times we've had these really large bearish readings, and you'll note that they generally come in before a rally. Of course, we didn't see that on this one. Everybody felt bearish, and that turned out to be correct. But in general, you want to watch for these and look for a rally out of them. And we've got that the last time we had these very low, or actually high, I would say, bear readings. So when you get more bears, that of course becomes bullish for the market. And you can see right here with the bull bear ratio, also very, very low. And I've marked those times, obviously they line up with the very low readings that we're getting right now, because there are only a few that are lower as far as the bull-bear ratio in the last 5 years. So this is very bullish for the market when everybody is getting very bearish. But here's the interesting thing. So now we're going to look at the National Association of Active Investment Managers. And interestingly, they're not as bullish or bearish as the individual investors. So there's a lot of fear out there as far as, your individual investors, but active money managers are still very high with their exposure. And I've marked it right here so you could look and see where we've had higher readings. And it's happened a few times. And generally that does, come in before a decline. So, the difference is for me here is we had this extraordinarily high reading beforehand. And, that really was the signal, I think, for the bear drop here that we got. And, the big guys, they tend to be somewhat correct here. So what we look for are those extremes, because that's where we really get the information we need. So while they are exposed higher than in general, I think that in this case, they kind of, they know that we're getting ready to sort of have this change, because it's just, I'm not seeing that climactic reading like we had before. So that's the only one, because let's look over here at the RIDEX analysis. Because when you look at this, everything else is pointing to everybody feeling bearish. So, having them still sitting on, pretty high exposure, that tells me that we might have to wait a little while. Everybody's going to start getting very bullish eventually. But right now, I would say people are feeling very bearish. And of course, that is bullish for the market. So let's look at our RIDEX asset ratio and where the money and assets are going currently with the market. And what we do is we follow a basket of stocks or money market funds, sector funds, and we look at those and we pull out the bear funds and look at the assets that are reported every night for the bear funds. And then we look at the assets for the money market, and we look at the assets for the bull and sector funds. And when you look at those assets, all of the three, and you watch where the ratio is going and you watch where the money is flowing, that can tell you what actual sentiment is. Everything else, you've got NAIM, NAIM, the investment managers, that's real money, because they're showing how exposed they are. But when you look at an AAII, that's just, people putting their finger in the wind. And it's real easy to say, I'm a bull, and then start selling your stocks. So we're looking at where the money is actually going, I think is very important here. So we have a rising trend that is still holding on the RIDEX ratio. And that's good, because typically when we get these highs, it precedes some declines. So we've already gotten that decline. We've gotten that top already on the bull-bear ratio. And so now I would be looking for this, rising bottoms, rising trend to hold. And, if we get another move back up, we might want to consider that as far as, a bearish sentiment setup. But let's look where the actual money is going. And I'm going to direct you to the thumbnail. It's a little bit easier to see. And as you can see, we're getting a slight increase in the bear funds assets. We're getting quite a bit of an increase in money market assets. And then a decrease, and you can see over the last week, pretty large decrease in the RIDEX bull and sector funds. So what is this telling us? Well, this is telling us people are feeling bearish, right, with their money. We're getting a rise in the bear funds, not considerable, but we're getting quite a rise in the money market funds. And that means people are cashing out, people are getting on the sidelines, or they're actually starting to think about shorting the market as they move into those bear funds. So to me, we're looking at bearish sentiment as far as where everybody is feeling. And again, sentiment being contrarian, that is bullish for the market. All right, I wanted to add one extra chart just because I thought it was interesting. And this is our gold and silver sentiment chart. Let's see if I can make it. No. Okay. And I just find this one interesting because we keep track of the premium and discounts on the Central Fund of Canada. And the higher the discount rate, the more bearish everybody's feeling. And typically when you get these high bearish readings, it's going to precede a move up in the price of gold. So we are starting to see an increase. I'll have to look back and see where this decrease and why we're looking at readings that are a lot lower than we saw back in 2017. But at this point, I guess we just had some really high discounts at that point based on the price. So I'm seeing bearish activity here, but I'm not seeing enough bearish activity. And I'm going to look at one more chart that I do have. And that is my gold chart because I put in the GTU. There we go. And so the Sprott Physical Gold Trust is the other premium discount rates that we look at. And honestly, this is the one I follow more compared to the CEF. But, Carl and I have talked about it previously. We're just not seeing enough of bearishness to give us the feel that we're going to have a bottom in gold at this point. And, it's been very negative. Obviously, gold has been taking quite a hit. We're now starting to get very close to support here, though. And I find that interesting. And we've got a PMO that is now very oversold. So we'll have to keep an eye on gold, but it is starting to actually set up for, I think, a bottom at this point. So we'll be watching that closely. On Monday, I'll be going over the monthly charts and we'll take a look at those and see where we're at. So let's go ahead and I'm going to, let's summarize here. So right now, put call ratio, neutral, somewhat bearish. We're starting to see a little bit of a move there in the right direction. Bull bear ratio, really low on AAII, really extreme right now. So that's really very bullish for the market if everybody's feeling that bearish. We can also see with name, we're still seeing an elevated exposure level. It did reduce back a little bit, and typically that's bearish for the market, but I'm not that sure this time. I mean, I'll just be honest. I think they might be on the right side of this based on just looking at what we're seeing on a sentiment in the other areas, like the RIDEX ratio. You can see that we've got money markets and bear funds are increasing, and we're getting that decrease in investments in bull funds. And so that's actually bullish for the market. So there's your conclusion and summary. I'm at this point, when I look at the sentiment overall as a whole, I think it's bullish. I think we're seeing enough bearishness out there that we can start looking for a short-term bottom. And that's what I'm looking for next week. And Tom, speaking of next week, let me go ahead and show that Wall Street sentiment chart. Okay. Let's get back to sentiment. Actually, I think I can just go backwards. There we go. Alrighty. So this is the survey that I take every week from Wall Street Sentiment and wallstreetsentiment.com. I don't have the reference here right now in this particular chart. But I thought it would be interesting. Last week, definitely a preponderance of bears in the very short term. I think, we called it fairly well. And we'll have to see what it's going to be this week. But what do you think? I'm actually, based on the short-term sentiment, Tom, I'm really thinking we're going to go higher next week. How are you feeling?
I agree with you. I think we're going higher. I think a number of things are beginning to set up here in the market. We got the dollar index breaking out. I know, you had pointed out that gold is approaching some support, but I would actually tend to take the other side of it. I think that gold relative to the S&P 500 is broken down again to lowest level that we've seen since 2010, 2011. And throughout that downtrend, and with the dollar breaking out, I think the dollar is going to go higher. So what I'm looking for, I think the S&P is going higher, but I think that the outperformance by small caps is going to continue. So I'd look for a rebound next week in the small caps, perhaps more than the S&P, but I think the market goes higher.
Okay, well, what does our poll say currently? Let's go take a look. And there you go. Looks like half of the audience right now is pulling for higher next week. And, only a quarter are in the lower category. So very interesting. I'll be turning in your votes and Tom's vote for next week to the Wall Street Sentiment Survey. And you can go learn more about that at wallstreetsentiment.com. So great show today.
Yeah, I do have, and one of the reasons I like the market to go higher is just because we're beginning of the month. And when you look back, starting at the beginning of the month, I mentioned earlier that 53% of the days on the S&P 500, we go higher, and that's going back to 1950. If you look at it on an individual day basis, the first of every month goes up 61.5% of the time. The second, 59.3, the third, 57.1, fourth, 54%, the fifth, 56%, and the sixth, 54.2. All 6 of those days, the first through the sixth, are above that historical norm of 53%. So there's just more of a tendency for the market to move higher. And the annualized return, the first 3 calendar days of the month are 46%, 36%, and 26%, way above that 9% average that the S&P enjoys throughout the year. So there are a number of historical reasons, I think, that set this up, but also I just think the market's oversold and is ready for a rally.
Yep, I have to agree with you there, at least in the short term. So I'll be watching. I suspect all of my short-term indicators are getting ready to make a turn up. And if you want to see more on those indicators, Carl is going to be writing the weekly wrap, and that will be published later today. He goes over all of gold, the big 4: dollar, gold, oil, bonds, and he looks at all of our indicators, short and intermediate term. So he'll give you a really good feed on what's going on in the market and what to expect next week. I'll be interested to see his opinion.
Yeah, as always. I mean, it's always nice. We've got so many technicians here at StockCharts, and of course, everybody has different ways of looking at the market. Some more systematic approaches, others gut. I won't say gut, but I guess in a way it's kind of your gut based on the strategy that you follow. But yeah, a lot of differing opinions, but the tendency is that we all look at the market pretty much the same way in terms of relative strength and some other key criteria.
Absolutely. Here's our upcoming schedule. I am still taking in the survey ideas for what my workshop should be on. So go ahead and start putting those ideas on that survey.
Sounds good. Well, this is the end of another week. I want to thank everybody for being with us today and, of course, every day. Remember to complete that survey as you exit. Of course, Erin just asked for some feedback for her workshop next week, so I'm sure she'd love to get some ideas there. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe, and we'll see you back here on Monday. Happy trading.
Volatility is back and interest rates are rising. With the markets headed into uncharted waters, ChartCon 2018 is here just in time. See how the experts are protecting themselves and watch live from the comfort of your home or office as they reveal the risk management strategies they use to stay profitable in any market. Plus, Plus, you'll get complete video recordings to watch on demand for years to come. Join us at ChartCon 2018, streaming live August 10th and 11th.